Hey guys and gals, it's Logan Freeman, and this is the LiveFree Investors Podcast, where I interview investors and business owners who share investment advice so you too can live free. Today, I'm talking to Brian. Brian, in a few sentences, tell us who you are and what you do.
Yeah, I appreciate it, Logan. I am a recovering attorney who got into the real estate business 10 years ago. So I'm a fundless sponsor and syndicator. And so we raise capital on a deal by deal basis for commercial real estate opportunities, which can include anything from office to medical, arts to flex industrial, et cetera. And we do three things: have a place where taxable investors can park their capital in an uncorrelated environment to the macroeconomics. We can achieve passive income and yield generation. And then we do a lot on the tax side internally to make sure that we're getting all the benefits that come from direct real estate ownership.
Thank you for that. And it is apparent that you have thought through when somebody asks you what you do. So I can't say thank you enough. I just spoke at another summit, was talking about, when somebody asks you what you do, you really need to be able to tell it. And I like the 3 points, man. So
Three
thank
things.
you. That might have been the best that I've had on the podcast so far. So I appreciate that.
Yeah. Well, after doing this for 10 years, if you can't tell somebody what you do, at a cocktail party in 2 minutes, they stop paying attention.
Yep, absolutely. And I'm curious. So you said recovering attorney. So what was that journey into the real estate sector and why?
Yeah. So I am extremely fortunate. I married into a family that has a single family office based here in Nashville that had invested in the commercial real estate space for the last 25 to 35 years. So when I joined the board as an ex officio member, I started meeting with some of the GPs and sponsors and fund managers we invested with, and just became enamored with the real estate space. Was lucky enough to connect with my business partner, who's more of a finance background, although also an attorney by trade. And when I was exploring making a move within the law, I started speaking to a lot of older attorneys who were kind of in that 55 to 65 partnership range. And pretty much to a T, they were all fairly miserable. They all had the golden handcuffs issue.
Sure.
And, real estate just seemed like a good opportunity, low barrier to entry business, inefficient market where some, young lions could go out there and start a business and create some wealth for ourselves as well. So that's how I initially got into it.
So you took matters into your own hands. You saw the action being taken by the GPs and sponsors and said, I probably can do that. Yeah.
Yeah, I mean, more or less, I started learning about the space, and we can get into kind of the investment thesis and what we do and how we do it. But
Yeah.
I just saw the opportunity that if you could hustle, if you were smarter than the average bear and could find some kind of inefficient market, blue ocean niche, that it was such a large asset class that you could go out and start your own business. And I'd seen entrepreneurs do that
Mm-hmm.
when I was younger. So that's what caused me to initially make the move away from law.
Was there anything in that move that, I know you mentioned golden handcuffs, but just more control of your life? And I always talk about, designing and having my business designed around my life, not my life designed around my business. Was there any of that notion that you were feeling as being an attorney? Because I have clients, friends, and other, folks in the industry that are attorneys or trying to transition out of that space.
Yeah, I mean, that's a great question. And that's exactly part of the impetus for starting the company. When I was talking to a lot of people who were at the very end of their careers as attorneys, you realize that the value creation you're making for the enterprise, even if you are a partner, is directly correlated to how much time you spend on something, not necessarily the value you create for the enterprise itself. And I thought that was a bad business model. And I didn't want to look back on my career and say, well, geez, I managed to bill 3,000 hours the last 10 years. And that's what, caused me to make more money and to ultimately drive more profits for the company. It just seemed like a bad way of doing business. And I didn't want to be a part of that. And my father's an attorney. My grandfather was an attorney. And I don't mind working hard,
Sure.
clearly, as an entrepreneur, but I didn't want to have that type of correlation from my efforts into, profits.
Yes. And what I've learned too, Brian, is early on, and I'm still very early in my career, but earlier on when I made the shift or whenever I took what Jerome calls the red pill, it was something that I tried to, prescribe to everybody that I talked to. And I realized that, whoa, man, like I started to really be polarizing in the wrong way. And so I do want to make the notion and the fact that this is not for everyone. If you are not willing to sit down and take control of your life and be able to ride the roller coasters of being an entrepreneur, it is not for you. There's a lot of folks that just need that stability. But for the select few, and if you have that itch, I would just really recommend continuing to scratch it, because there's no better time, in my opinion, to become an entrepreneur. I mean, think about 25 years ago, how hard it would be to connect like this and get this message out to, now we're probably going to get this out to 10,000 people next week. Like that is, infinitely easier to get that out and get started. So I don't want people to think that it's so hard that you can't do it. But I also want you to, people to understand that it is not all rosy, and it takes a lot of work. And being, what I'm going to say is, being an entrepreneur, sometimes you end up working more if you're not careful about how you're going about it, because it starts to turn into love of what you're doing. So anyways, that's another topic for another day. But I appreciate just hearing, that message of, look at what you could be or other people are 25, 35 years ahead of you, and say, is that what I want my life to look like? I mean, that sounds like what you did. You reverse engineered that, and you made some choices that now you're rocking and rolling. So I just it's very inspiring to me. So I just want to say thank you for sharing that.
Yeah, absolutely. I think one of the things that gets misunderstood by a lot of aspiring entrepreneurs, especially in our space as a sponsor or a GP, is the fact that you are in the real estate industry and you're making real estate investments, but you're also starting a small business.
Mm-hmm.
And small businesses in America fail. That's just
Yes.
the numbers and the percentages bear that out. It's a very challenging thing. And so you're taking a dual risk. You're taking the risk as a small business entrepreneur, and you're also taking the risk as a real estate investor. And I don't think it's fully appreciated,
Mm-hmm.
both on the sponsor side, but also on the investor side, of what goes into both of those things. And frankly, considering the scale of the enterprise that we have today, I spend a lot of time just on the business
Business.
itself as opposed to the real estate, because I have some really smart real estate focused folks that are taking care of all that. But running the infrastructure and scaling it efficiently is a big challenge, and a big mistake I made midway through my career that I think a lot of people fall into that same trap.
If you don't take anything away from this show other than that, if you're an aspiring real estate entrepreneur, any type of entrepreneur, and you're in a certain niche and you want to be a small business owner, you have to not only be an expert at that niche, but also an expert at building a business. They're two separate things. Thank you for, deciphering and breaking those out. I've talked a lot about, the difference between being an investor, a real estate investor, and the difference between being in the business of real estate investing. And you just made that much more clear. So thank you so much, man.
Absolutely.
Brian, 2020, crazy year. Every year is crazy in my life, but 2020, just from a existential circumstance, was wild, and it's still going on, right? I mean, we saw what happened at the White House just recently. Just a lot of craziness going on that is hard to get through the noise, get through the clouds, and see clearly. I saw you still taking action. I saw you guys still deciphering what was going on in the economy, in our financial system, and making choices on that. So how do you keep up to date on those current opportunities and all of this different data, and then make choices on that? I know it's something that I don't know how many people follow you on LinkedIn, but you'll see Brian's long form posts. Spend some time and read those, man. You will get so much out of that. So can you talk to us a little bit about that?
Yeah, absolutely. And this is a question I get a lot from obviously aspiring GPs and sponsors, but also just investors that are looking to get into the private marketplace in real estate. How do you start, right? And how do you that first step and pull the trigger and actually make an investment. And my advice is always, you need to have an investment thesis that you believe in, that you can see and touch every day. And then you can make allocations based on that investment thesis. And so for us, very early on, we had the concept that this maturing millennial generation, which because of the Great Recession pushed back their family formation phase on
Mhm.
average 3 to 5 years, we're going to leave major coastal markets because of access to single family homes, access to education for their children, and quality of life and cost of living. And so that led us to growth secondary markets, much like Kansas City, which we're very bullish on. So once you have an investment thesis that you believe in, that you can touch and feel, I'm 38, so I'm barely a millennial, but I do qualify. And
Yep.
I saw this playing out in real time starting 10 years ago from my buddies in New York, 1.5 kids, Upper West Side, getting taxed to death, and working to the bone.
Yep.
They were boomeranging back to what we call Big 10, Big 12, SEC country.
That's
And
right.
so we saw this playing out on the employee side. What was interesting is that as it developed, we saw employers say, gosh, to access that human capital, to access that employee base, to stay competitive in our market, we need to have a physical footprint in these markets. We need to plant a flag. And so you saw Alliance Bernstein move to Nashville. You've seen some relocations to Kansas City recently as well. And so taking all that into account, we have a very thought out process of macroeconomics, what we see playing. And then we have a thesis about how to attack those markets and how to invest there, which we can get into how we evaluate and analyze an MSA in the submarket. But considering all the noise and the amount of data that we get every day, it can be paralyzing. Like
Mhm.
paralysis by analysis, I think, is a real thing. But if you have a well thought out investment thesis and you have a way to exit it, you shouldn't worry on the day to day. And one of the best things about commercial real estate is that there's no scoreboard
Yeah.
on a daily, monthly basis, right? Especially for office, it can be a fairly static asset class, which I think is a good thing. So if all my investors had their druthers, they probably would have cashed out in April and May at a steep, steep discount like you saw in the REIT market. But instead, we've held on, we've continued to acquire, and we've been able to make distributions. We feel really good about where the portfolio is and where the long-term benefits will come. So I think I've answered your question by saying you need to have some high conviction, and then you can't Monday morning quarterback it every single day, because otherwise you won't ever participate in that upside because you never put any money to work.
I love that, and I'll just piggyback on that because in December I was sitting on a decent amount of money for me, and I said, man, what do I do with this? Should I allocate it to the stock market, put it back into real estate? And 90% of the money that I have is in real estate basically, but I needed to put, my wife likes to put some money into the stock market and all of that. So I call Creative Planning up, which is our firm here. I said, hey, Joe, what should we do? And all he looked at, and this is why I love creative planning, is because he said, he answered my question with a question. And he said, are you asking me to allocate this certain amount of money to the strategy that we set out forth 12 or 15 months ago when we sat down and talked through everything? And that was it. And I think I learned so much from that question, because he's not wavering, that creative planning is not in the business of trying to time the market, and they just continue to do the same thing over time. And so you can debate that, one way or the other, but I think if you take that notion of staying consistent, staying highly convicted, like you mentioned, and then making decisions based on that, it's probably going to be successful. So I really appreciate you having that investment thesis, sticking to it, no matter what other people are doing or other things are happening. It's what you guys are seeing, and that's where true thought leaders, operators, and principals make their money. That's what investors pay for, in my opinion. In this space that we're in, I know you're in a different asset class, but in the multifamily space, it has just blown up from all this education, and that's fine. But there's this educational bubble, I think, and it's all about, we got to do deals and we have to watch what everybody else is doing. And if you're doing that, you're just following the crowd. What I see from you is contrarian. You're thinking about things differently because you've done the research, you've looked at the data, and you are making decisions based on that. If any investor hears that, you need to make sure, if you're looking to invest with somebody, that they can talk to their thesis and how it is being affected or not affected by what's going on in the economy. So, you're making me want to invest with you, Brian.
Well, you know, it's not that different. I mean, obviously there's some components and details between commercial and multifamily, but
Yeah.
fundamentally it's about demographics, right? Demographics are destiny. Where's population growth occurring? Where's job growth occurring? Where's wage growth occurring? And when you kind of track all those things and you don't worry about what's happening day to day, and you're looking at a 5+ year hold period, which is kind of where long-term investors, you can't get caught up in the noise.
Yeah.
Otherwise, you just won't ever make any real money.
Yeah. Well, let's talk about some of these ways that you are looking at markets, because one question I get all of the time is why Kansas City? So I end up writing and making content a lot about making the case for Kansas City. I think you'll agree with some of the notions that I put out there. But let's start at a high level. You've got a new MSA that you're taking a look at. Where do we start?
Yeah, so we focus on secondary markets, which is a squishy Wall Street jargon term,
Sure.
which we try to put some structure around. Million plus MSAs, so cities that have a million plus people. MSA can be also a very squishy term, so let's just kind of say that that's a major metro area, but it's outside of the top 10 traditional gateway markets. So Kansas City is a great example, considered by a lot of Wall Street and West Coast folks as a flyover city that they've never been to. But if you take a step back and look at how it has really behaved the last 5 or 10 years, population growth has been really good, wage growth has been good, job growth has been good. The underlying economic drivers are education, healthcare, because you've got University of Kansas, Cerner, and then increasingly a lot of STEM industries, so knowledge-based economies, which we think are going to be countercyclical and very resilient during a downturn. So we like the story. We understand the story. One of the cool things about Kansas City that I don't think people understand or realize is it has the second largest railroad freight volume behind Chicago in America.
Mm-hmm.
And it's the only major metro with a Class A rail line that runs north-south and east-west.
Yes.
So when you take a step back and think about e-commerce, you think about distribution centers, you think about what's happening, especially from this, COVID type era that we're working through, KC makes all the sense in the world for a corporation to locate the Midwest, because you have to go through there. So we love that component on it.
Yeah.
And then frankly, especially on the Kansas side, we're focused on the South Johnson County submarket.
Sure.
And we can get into how we think about submarkets, but it's probably the best suburban office submarket in the MSA. We love the affordability factor. I mean, we can buy Class A buildings at a 7 or an 8 cap with moderate leverage. We're solving for anywhere from a 9 to a 10% cash on cash yield. And these are 90% plus occupied day one buildings with a weighted average lease term of north of 4 to 5 years.
Yeah.
So great stability. You're not going to get tremendous growth probably, but the dynamic that we'd love to see that is very prevalent in the South Johnson County KC submarket is that we can buy things at a very steep discount to replacement cost and also replacement rents.
Right.
So what I mean is we can buy a building at $150 a square foot on per pound basis, but we can also buy it at, call it Class A rents or $25, $26 a square foot. To justify new construction, you need to be $36 or $40 a square foot. So we love that delta because we feel very protected as a landlord that nobody can throw up 200,000 square feet of spec and steal our tenants.
Right.
And we can, bump rents 2, 3, maybe 4% annually, but we're still capturing that nice cash on cash yield.
Yeah, man. I mean, one thing I want to talk about too, thank you for breaking that down, is, the behavior of Midwesterners. And what I mean by that is Wallet Hub just recently did a study around 51, markets, so including DC, right, and all the states in DC. And they basically tried to look at, how were the states affected by COVID from an unemployment standpoint. And I don't know exactly what else they looked at, but it's probably heavily focused on unemployment and maybe something else, but or maybe population growth. I'm not sure. But Kansas City was ranked 48th out of 51 on being affected negatively. So it held up very, very well for all of those reasons that you just mentioned. On top of that, Kansas City and Midwesterners, I think people that have not come here, they don't visit here. Yes, we're a decent size, MSA, I think is close to 2.4 now, pretty close to that. And we have great big businesses and a nice downtown, but there's still a lot of country folk around here, and things still move. Farms, a lot of agriculture, a lot of railroad, a lot of manufacturing, a lot of warehousing. That's kind of really the underlying foundation of our city. And the behavior and the mentality of Midwesterners is, I got to put my shoes on, I got to go to work, and I want to be around people. That is the biggest thing. So that will take us into the asset class that you guys focus on. When people think about investing into an office building, I kept hearing early on in the the COVID era back in March and April, oh my gosh, office is just going to fail 100%. I made 3 or 4 calls to office property managers and said, hey, what's going on? They're like, people are coming in as much as they possibly can. And so I want to hear your thoughts and your theory around this. I have my own that I'll share, but curious to hear your perspective on that.
Yeah. And so just to give people a little bit of context, the portfolio today that we run is around 2.5 million square feet. So it's about $460 million gross asset value. And we're in 12 markets total in the Southeast and Midwest. KC is probably one of our biggest locations, but we are in other markets. Pre-COVID, 4% of the workforce worked remotely. Mm-hmm. And it's important to draw a distinction between remote work and work from home. They're two very different things. Clearly, in a post-COVID world, more people are going to work remotely more often, right? So we envision a world where there's more of a hub and spoke model, where the employee base is distributed across a number of secondary markets and secondary offices, and they go in 2 to 3 days a week. That being said, this trend line that we saw from 2008 up until COVID of massive densification, what we call the WeWork effect, where you had sometimes in these locations in major coastal metros, you had 75 square feet per user in some of these places, whereas a traditional office layout with a door and all that would be around 350 square feet per user.
Yep.
So when you take all that into account, clearly, I don't care where we are in the vaccine, nobody's going to want to go hoteling, hot desking, benching back into the bullpen anymore. They're going to want more space, more privacy, more focus when they are in the office. And then offices are going to be a place where creativity and collaboration occur, because you can't do that remotely or working from home. So there'll be more multi-purpose areas, larger rooms where people can trade ideas, have conversations. Sales and development folks, especially in marketing groups, are going to want that. So when you take that all into account, I frankly think it's going to be a wash. Now, there will be some winners and losers. Sure. I would not want to be an office landlord in Midtown Manhattan right now or downtown San Francisco. I just think that there's going to be a lot of pain in those areas. But to your point about the Midwest, these are fairly conservative places for the most part. They've got pretty balanced budgets. Mm-hmm. Whereas if you look at New York and California with the mass migration that's occurring, what's going to happen there is a death spiral where politicians are going to have to increase taxes on the affluent tax base. They're going to have to decrease services, which means that affluent people are going to leave. They're going to take their businesses with them, which is only going to mean that they're going to increase taxes more and decrease services more. And you're seeing this play out in real time today with what's happening with Wall Street firms going to move to Florida, Tennessee, Texas, California is going to Texas, et cetera. It's only going to be exacerbated over the next 3 to 5 years.
Yes. Well, those are all fantastic points. And even my behavioral psychologist in me, if I probably wasn't going to be a business person, I'd probably be in some sort of behavioral psychology. It just fascinates me, learning about why people do what they do and what drives them. It's just one of my hobbies to learn about, but then obviously helps out in the sales and marketing side of our business. But we have to remember that we're social animals. My wife works for VML Y&R, one of the most one of the larger companies in Kansas City on the marketing and advertising side of things. And if you need to talk about collaboration and getting insightful ideas, I think those people are burnt out completely looking at this little camera that's sitting on top of my computer here and want to be around people. And she's like, man, I just miss like the banter that you would get, just, throwing ideas back and forth and being able to say, hey, John, what are you working on over here? And can you help me with this, instead of typing somebody something and saying, hey, can you Slack me for 15 minutes or whatever it is? It's just not fun. This whole idea of like working from home is cool until it's not, until you don't have a routine, until your kids are running around left and right, until you've worked in every room in your house because you can't figure out where you're most comfortable. It's just like, it's just a different mentality. I think that the Midwesterner markets also have less of those jobs that, you can just sit behind a computer screen and just make, a bunch of money doing things on, writing code or building websites or whatever it is, that those companies do. So I just feel like in the Midwestern markets, people are itching to kind of get back. And I see that, not only in our office, we are purchasing an office right now. I see that, and there's other tenants there. I mean, there are people going there trying to be safe and doing their thing, but they really want to be around people because they're social animals. I think we can't forget about that.
Yeah, we all suffer from recency bias. We think the way that we lived the last 6 months is going to be the way that we live the next 6 years. And
Yeah.
that productivity spike that we saw in Q2 when everyone was talking about like Twitter, oh, we're never going to have an office again. Well, by Labor Day, people had been pretty burned out. They were suffering from depression.
Mm-hmm.
That productivity had gone away, and that initial fear of getting fired had gone away, and the novelty had worn off, I think, pretty considerably. So I don't think it's going to be like retail where it's a secular decline. I think office will continue to be part of our professional lives moving forward, but it'll just be a little bit different how we leverage it as a resource. That being said, we're very conscious of the fact that now is probably not the right time to buy a suburban office property because it's hard to underwrite lease renewals, new leasing activity, et cetera.
Sure.
It's going to be very muted. So we're doing a triple net deal right now, which is a little bit different. We have done flex industrial in the past, so obviously that's a great space to be in today. We're about to, I hopefully, put an offer in on a deal in Detroit in that world today. So that's why I like being a fundless sponsor. We can be flexible and go where opportunity is.
Yes.
But I do think long-term office is going to be a resilient asset class.
Brian, you mentioned the recency bias. I've been recently studying cognitive biases, and I just bought Poor Charlie's Almanac, which is a hard book to get, by the way. I can't wait to put it up here on the shelf. But is that one of the biases that are out of that book?
The recency bias?
Yeah.
Yeah. I actually don't know.
Okay.
I know my folks used to read the Farmer's Almanac all the time back in
Oh,
the
yeah.
day.
Poor Charlie's Almanac is Charlie Munger's book that he put out.
Got it.
Yeah.
I'm not as familiar with that one, but it certainly is something that we all suffer from. And if you look at what's happening on the private equity space today, I mean, there's a reason that Facebook and Amazon and Microsoft and these big boy private equity groups are out there buying office. I mean, they're not stupid. They truly believe that it's going to come back in a fairly large way. And you see there's an announcement today that Alex Rodriguez and some folks are putting a lot of money to work developing multi-use, including office in South Florida. So,
yeah, I think it's something to keep our eyes on. Okay, shifting from the commercial real estate world, let's go into your best advice that you might be able to share as a business owner and as an investor. And I know that's a hard question because there's a lot of advice that you probably have received, but what's one thing that has stuck with you for a long time?
Yeah. So on the investment side, if you can't explain to me in a sentence how an investment opportunity, be it a real estate deal or a company, how they make money, and if you can't formulate that yourselves, you probably shouldn't invest in it.
Mm-hmm.
Which is why I have trouble investing in, say, Bitcoin.
Sure.
Because I can't explain it in a sentence. And if I don't understand it, I probably should not be taking that risk myself. And so that's something that I kind of live by and that our family, believes pretty strongly in. And then on the business side, I think it goes back to what I talked about before about how no matter what industry you're in or sector you focus on, you also have to make sure that you have spent. I know you're going through this process right now. I see how fast you're growing. It's remarkable, but you cannot scale efficiently unless you take some money out of your pocket and some time out of your day to build the proper infrastructure. And that was a huge mistake I made midway through my 10-year career, where we were just deal guys.
Yes.
Where we were acquiring, the assets were performing, but our investor relations and our marketing and reporting and accounting and tax were suboptimal. They were poor. They just were not up to snuff. And it caused us to pretty much delay everything for 2 years while we put that all back together. And now we have great systems in place, but you've got to make sure that you are constantly building the team and your capacity to grow on the investment side.
Yes.
And again, I think that's just a huge mistake that a lot of people make.
Man, spoken like a true business owner. I really appreciate that. It hits home for me right now because at 2:00 our time, I'm going to spend 3 hours with my 2 business partners talking about the 3 people that we are hiring right now. So I appreciate hearing that from you. So I'm curious. I want people to be able to find you, to follow you. What's the website that folks can reach out, and where can they connect with you, Ryan?
Yeah, so I really appreciate that.
Yeah.
ExcelsiorGP.com. We send out a monthly newsletter. If you're interested in learning about the investment opportunities, that's probably the best entry point to get you started. We also have a great resources tab there with blogs, webinars, etc., more than you probably ever want to know. And then, as you alluded to, I'm very active on LinkedIn.
Yeah.
So look me up, Brian C. Adams, Excelsior Capital. Shoot me a message, connect with me. I'm happy to set up a time to talk, chat if you want some advice. I think it's a great platform, and it's an incredible way to meet people. I mean, that's how we met.
Yeah.
Gosh, early in the pandemic, before I even had a podcast or was doing any of these things, you gave me a ton of free advice. And so to the extent that I can give it back, I'm happy to.
Well, you are a true go-giver too. You've extended your arm out for me multiple times, and I appreciate that. I do hope that the next time that you come visit Kansas City, we're able to spend some time together, touring
get some burn ends, get a couple beers. Yeah,
that
absolutely,
would be
man.
awesome.
We closed the deal December 23rd.
All right.
College Boulevard. Yeah.
Yes. So, okay. Yeah. I don't live far from that, actually.
Okay.
I'm on the Missouri side, but right over on 113th and State line. So college.
Oh, nice. Yeah. 8300 College. We just closed the 23rd. So
awesome, man. Well, congratulations.
Out, yeah. Thanks.
Nice to get one right there at the end of the year too.
Yeah, it was very nice. Yeah.
Yeah. We closed one on the 29th. So I'm right there with you.
Yeah.
Right at the end of it. Okay, guys. Well, this is Logan Freeman with the LiveFree Investors Podcast, where investors and business owners share investment advice so you too can live free. For more insights and ideas on how you can live free, connect with myself and Brian on LinkedIn. ExcelsiorGP.com is where you can go check it out. Join the newsletter. I know I'm going to do it right now just so I can download his knowledge into my brain. And I was making notes. If you saw me look away a few times, because there are certain times in the episode that I needed to go back and listen to and steal those talk tracks about Kansas City. So thank you so much for your knowledge, Brian, today.
Yeah. Well, hopefully we'll see if the Titans see you in the playoffs. We'll find out. So
I don't think the Titans want to see us again, but
no, probably not.
I don't really want to see Derrick Henry again either, though. So
yeah,
we'll see how it turns out. Thanks so much for joining us today, Brian.
Thanks, man.